Hello and good morning, folks. Welcome back to Almus Market Mornings with Shikhar Garg, and it's the MPC day today. Do we have a rate hike or does RBI hold? That's a question which is being asked by many, and if we have to see traders, they've been on the fence, but there are also a lot many economists which are rooting for a quarter point hike. There's kind of a mixed signal by the global counterparts or the global central banks. For example, Australia halting their rate hike cycle while New Zealand hiking by more than expected quantum. Banking concerns have eased, but oil prices have continued to rise over the week. India's offshore swap curves beyond April look flat, pointing at the market expectations of a peak in sight. So, JK, quite a mixed bag of factors at hand. What do you expect from RBI? What should we be expecting from them?
Yeah, good morning. Personally, I expect a 0.25% hike from RBI and possibly change their stance to neutral. And, possibly indicating that, future policy moves will be data dependent. So the reason I feel is because inflation is still above 6%, obvious to everyone, well above the upper limit of the band permitted for MPC. And then also, if you have to pause, you have to admit that the market economy is slowing down. Like we have seen in Australia and Canada, when they passed recently, they actually pointed to economy slowing down, and they wanted to see the lag effect of the rate increases done so forth. So if RBI is ready to do that, I mean, if they want, if they have sensing that the economy is really slowing down, then they will have to say that and go into a pass. Otherwise, data factors on inflation and core inflation, which they are repeatedly said is very sticky, is going to keep the rate hike on course. And of course, forecasts on GDP and inflation will be also keenly watched, particularly on GDP, because several agencies have come and downgraded India's growth prospects. Recently, World Bank and ADB have downgraded the growth. So all in all, it's going to be a very eagerly awaited decision. And if they do hike, and even if they do hike and indicate future moves being data dependent, I think that will be good for the market, particularly on the equities, and also for the USD INR as well, because I think that can actually trigger more flows into Indian bonds. Going on to the global scene, both stocks and yields dumped yesterday on several indicators pointing to US economy getting into a recession. Treasuries rallied for the sixth straight trading day on heels of weaker than expected ADP and ISM services data. And current pricing indicates, 2-year of, current pricing actually foretells imminent recession, and 2-year falling to 3.64%, which is 52 BPs from the recovery high of 4.17, and 10-year by 35 BPs from post-banking crisis recovery. And they all, that even made a cycle low on 10-year. So triggers coming from, preliminary employment indicators like ADP coming lower. And then in previous day, we had the job openings falling significantly from the previous month as per JOLTS data. ISM services and manufacturing both indicating that the employment component was falling, and even the price paid component were lower in both the reports. So all these things giving a sense that at last the rate hikes by the Fed is having its impact on the economic activity, and that is why even the stock markets have started to see lower earnings as eventual outcome, because if the economy is slowing down sharply, companies' earnings will also be affected. So along with lower yields, we had lower stocks as well. On the dollar, of course, we did see some strength into the dollar, and that I will put down more to profit taking because we have the non-farm payroll report on Friday when most of the market will not be working, and therefore the profit taking approach by players has kept the euro down by about 0.5%, and similar on the GBP as well. In fact, if you look at it, the fall in the dollar for the last 6 months or little over 6 months has been led by the rally in euro and the GBP. And in my view, I don't think they have had a full-blown correction. And if hard data, the data that we had seen so far, they were all mostly second tier data, and the hard data like inflation, monthly inflation data, which is coming on next week, and then retail sales as well as the non-farm payroll tomorrow. If these do not indicate a sharp slowdown, then there may be renewed thinking on how Fed will approach in May. As of now, more than 50% are expecting a pause in May, and some even expect a rate cut from July onwards. But I think they are too optimistic. We need to see more evidence from the hard data before we conclude that. So back to the dollar, I think yen is very interesting. The 10-year JGB yields are closer to 0.5%, which is the ceiling of Bank of Japan. And along with the fall in the US yields, I think yen has become, more risky to sell. And the carry trade is also becoming less attractive. Hearing more and more interest from Japanese exporters to sell USD against Japanese yen, and I think that will continue. 131 holds immediate support, and on break and close below that, we should see it going towards the previous low of 128. On the dollar pay, obviously yesterday we had flow related selling, and it was a day when the PSU banks really played hide and seek, now there, now not there, and that actually kept the market very volatile. Even though we did see a fall from 82.20 up to 81.92, 93, it was very, very choppy, and interspersed with PSU banks coming now and then, and eventually we did close a little bit higher from the lows. Offshore market again saw it as low as 81, 86, but due to dollar index rising, it has come back to near 82. But I think it depends on whether we have the flows hitting the market again, and it's down to that, and whether PSU banks want to absorb all the flows at these levels. All said, we think USD INR underperformance can correct a bit more, which will reflect also in Euro INR and GBP INR correcting down, which have seen very good highs in recent days. So we have a long weekend coming up, starting tomorrow. Good Friday, and it's not really a holiday in the US, although markets will be very thin. Non-farm payroll report will also be published tomorrow, and we come back on Monday with the latest update. Thank you.
Okay, JK, that was quite good. And yes, folks, as JK mentioned, we have a long weekend coming up, and we have also observed a lot of profit taking being carried out by traders when it comes to dollar and euro and other major currencies. But what's quite interesting to watch will be the NFP reports on Friday and the rest of the data, which can actually set the path for Fed's approach in the coming FOMC meeting. And if we have to talk about central bank meetings, as JK mentioned, he's expecting a 0.25% hike and a change of stance to neutral, which is quite interesting to watch, as many traders are on the other side, while economists, as I mentioned earlier, are expecting a 0.25% hike. But as JK mentioned, if there is a halt, they'll have to admit that a slowing of economy is in sight, and is a reasonable approach towards slowing down the rate hike cycle for the economy to continue its path. That's it for today, folks. We shall come back again on Monday with another round of updates. Thank you so much for listening.